Imagine you're standing outside, like the hottest nightclub in the city.
Okay.
The velvet rope is up, the bouncer's checking IDs, but something looks a little off, like the line wrapping around the block. It's getting noticeably shorter.
Right. Never a good sign for a club.
Yeah, exactly. You peek inside, and the dance floor is half empty. For any normal business, this is the moment the owners panic.
Oh, yeah, absolutely.
But then you look over at the bar, and the cash registers are ringing louder and faster than they ever have in the history of the venue. So somehow the owner is making more money than ever with a shrinking crowd.
Which is wild. I mean, it breaks almost every conventional rule of hospitality. And frankly, it breaks a lot of rules in the software world, too.
Exactly.
You're looking at a structural transition playing out in real time.
Yeah.
Because the question isn't just how they are pulling it off tonight, but whether they can, keep the doors open tomorrow.
And that is exactly what we are unpacking today for the Talk Tickers community. Welcome to the deep dive. We are looking at Match Group today.
The corporate giant behind Tinder, Hinge, and a dozen other platforms.
Yep. And we're breaking down their second quarter 2026 earnings call transcript. Our mission here is really clear. We are cutting through the Wall Street jargon, pulling out the most critical data points from this call, and figuring out what it actually means for anyone holding or considering Match Group stock.
Right, no fluff.
No fluff, fast-paced, data forward, because, we want to give retail investors actionable takeaways.
Which really requires looking entirely past the surface level narrative. When you dig into these transcripts, the real story is almost never in the headline revenue.
Right.
It's hidden in the engagement mechanics and the margin expansion.
Let's start with those top line numbers because they set up that exact paradox we just talked about with the nightclub.
Yeah, let's hear the raw data.
So total revenue for Q2 came in at $853 million. That is down 1% year over year.
Okay.
And if you strip out the noise of foreign exchange fluctuations, so like if we just look at the raw performance of the business, ignoring how the dollar is doing overseas.
On an FX neutral basis.
Right, exactly. It actually down 2%. So as an investor, shrinking top line revenue for a tech platform is usually the moment you just hit the sell button.
Oh yeah, that's usually a massive red flag.
But, and here's the crazy part, their adjusted EBITDA, which is the metric Wall Street uses to measure core operational profitability, somehow that jumped 14% to $331 million.
Wow.
Yeah. It gives them a massive 39% profit margin.
Let's pause on that 39% margin for a second, because that is a staggering number for a mature technology company in a turnaround phase.
It's huge.
Right. You have a business that is bringing in fewer total dollars, yet they are squeezing 14% more actual profit out of the operation.
Yeah.
And in the app ecosystem, you don't achieve that by accident. It points to a very aggressive recalibration of how they extract value from the users who are actually sticking around.
Right, paired with ruthless cost-cutting behind the scenes.
Exactly.
Well, the extraction part is what jumps out immediately in the payer data. Overall paying users across the entire Match Group portfolio dropped 6%.
Okay, so fewer people paying.
Yeah, they're down to 13.3 million paying users. But the revenue per pair, the RPP, increased 6% to $21.13.
Interesting.
So applying my nightclub analogy again, the line is gone, the dance floor is thinning out, so management just decides to charge the regulars $40 for a cocktail to make up the difference.
Right.
I have to be honest, looking at this from a Talk Ticker's perspective, that feels like a death spiral. I mean, you can't just infinitely squeeze a shrinking user base.
It is a totally valid red flag to raise. I mean, when prices go up while volume goes down, the instinct is to assume management is panicking to meet quarterly targets.
Exactly my thought.
But the transcript paints a more nuanced picture. What's fascinating here is that management explicitly argues this is a deliberate transition phase, not a desperation move.
Really? A deliberate phase?
Yeah. You have to look at the spread, the difference between the decline in overall casual users and the decline in actual paying users.
Okay, walk us through that spread. How does losing users actually become part of a deliberate strategy?
It comes down to intent. The rate of decline in payers is actually slowing down compared to the decline in total monthly active users, or MAUs.
Okay.
Tinder's overall MAU is down 7%, but their paying users are only down 5%.
Ah, I see.
Because that spread exists, payer penetration, so the actual percentage of the total user base that decides to open their wallet, is up year over year globally.
So the people leaving the app are mostly just the casual, passive swipers.
Exactly. The people staying are highly engaged, high-intent users, and Match Group is getting much better at monetizing them. In fact, Tinder's direct revenue per monthly active user is actually up 6% globally.
Okay, so they're essentially shedding the window shoppers to focus on the VIP room.
That's a good way to put it.
But even if you are monetizing the core base more efficiently, you still have a top-of-funnel problem.
Right, eventually.
Yeah, you eventually run out of VIPs if you aren't bringing new people through the front door. If I'm an investor, I want to know exactly what they are doing to fix the product so people actually want to download the app in the first place.
Which forces us to look under the hood at Tinder, because Tinder is the engine driving this entire company.
Yeah, it's the big one.
It represents over half of their total revenue.
Yeah.
$457 million this quarter alone.
Wow.
If Tinder sinks, the whole ship goes down. And Spencer Rascoff, the CEO, essentially admitted on the call that prior to his tenure, the app was stagnating.
Yeah, he didn't sugarcoat it.
No, they were not shipping new features fast enough to keep up with the changing social habits of Gen Z.
Well, they're definitely trying to make up for lost time now, because the product sprint they outlined in this call is massive.
It really is.
They just executed their first full brand overhaul in nearly a decade. New colors, typography, the whole visual identity.
Right.
But a fresh coat of paint doesn't fix a broken engine, you know? So they've also ripped out the old matching logic and rolled out entirely new AI recommendation algorithm.
The AI implementation is critical because it changes the invisible physics of the app. It's not just about showing you more people.
Right.
It is about showing you the right people faster, reducing the fatigue that causes users to churn out.
And they are testing some wildly different features to combat that fatigue. There is a feature called Missed Connections, currently being tested in Canada and Australia.
Oh yeah, I saw that.
It uses your location data to surface profiles of people you physically crossed paths with during the week.
That's super interesting.
And they're also testing text-based search in Canada, where they noted 10% of users have already adopted it.
Which is huge.
Yeah, linger on that for a second, because a text-based search bar on Tinder completely changes the dynamic of how the app is used.
It represents a fundamental shift in user behavior. Because for over 10 years, the paradigm of Tinder was passive discovery.
Right, the endless scroll.
Exactly. You sit on your couch, you are fed a stack of cards, and you react to them. Swipe left, swipe right.
Yeah.
Text-based search introduces active hunting. If a user can type in loves hiking or musician, you are allowing them to bypass the algorithm entirely to find exactly what they want.
Wow. Yeah.
Gives the user agency, which is a core demand of the Gen Z demographic.
It also gives Match Group incredibly valuable data on exactly what their users are actively looking for, rather than just guessing based on swiping habits.
Absolutely.
But the most aggressive swing they are taking to fix the top of the funnel isn't happening on a screen at all. It's Tinder events.
Right, moving offline.
Yeah, moving into physical, real-world events feels like a massive pivot for a company whose entire business model relies on keeping you glued to a digital interface.
It was one of the most heavily scrutinized topics during the Q&A segment with analysts.
I bet.
They piloted this concept in Los Angeles starting back in March, hosting over 60 in-person events.
Wow, 60 events just in LA.
Yeah, and the engagement data they brought to the call is hard to ignore. 71% of eligible users aged 18 to 24 engaged with the in-app events tab.
Oh, wow.
And over half of them returned to the tab the following week.
Okay, the scale-up plan is aggressive too. They expanded to 10 cities by August. They expect to be in 26 cities by September, and they are targeting 75 cities by the end of the year.
That is moving fast.
Very fast. They noted they are using AI to compress their internal development cycle so they can roll these local partnerships out in weeks instead of months.
Which is smart.
But this all brings us to the ultimate question for the retail investor, right? Is any of this actually stopping the user bleed?
To answer that, we have to look at the leading indicator that Wall Street obsesses over in a turnaround. Daily active users, or DAU.
And this is where I need you to convince me, because looking at the Q2 data, Tinder's DAU declined 4% year over year.
Okay.
To a retail investor, down 4% is still down. The user base is shrinking. So why are analysts treating this like a victory?
Because in turnaround physics, you don't look at the absolute number first.
You don't.
No, you look at the rate of change. You look at the second derivative. Less than a year ago, Tinder's DAU was falling off a cliff, declining at roughly 10%.
Oh, ouch.
So getting that bleed down to 4% in Q2 is actually their best result in 10 quarters.
I see.
But the real story management revealed is what happened after the quarter ended. In July, that decline improved to down 2.5%. And on the call, they stated that in August, the DAU trended almost positive.
Almost positive. Wow. So they are on the verge of crossing the zero line.
If they cross above zero, it will mark the first time Tinder has seen positive year-over-year usage growth in over 3 years.
That's a huge deal.
DAU is your canary in the coal mine. Before users open their wallets to pay for a subscription, and before the monthly active user numbers stabilize, the core group of daily users has to start opening the app more frequently.
Right. The engagement has to be there first.
It signals that the new AI algorithms and the app redesign are actually holding people's attention.
And they back that up with a metric they call Sparks, which is their internal term for meaningful matches that lead to conversations.
Clerks.
Yeah. In July, the number of unique people getting Sparks was only down 1% year over year, and they noted August was looking even stronger. The product is just functioning better as a matchmaking tool.
And crucially, it's functioning better for the most important demographic in the entire ecosystem.
Which is?
Young women. Spencer Rascoff was very explicit about this. An ecosystem like Tinder is a two-sided marketplace. The entire financial model collapses if women don't find value and feel safe on the platform.
Yeah, that makes total sense.
They pointed to marketing campaigns like Music Mode and Astrology Mode, which specifically drove improved new registrations among young women.
Oh, nice.
Prioritizing the female user experience isn't just a PR talking point for them, you know? It is the mathematical foundation of their turnaround strategy.
Okay, so Tinder is the slow-turning battleship. It's taken a long time, but the underlying metrics suggest the rudder is finally catching water. But if Tinder is a battleship, Hinge is a rocket ship strapped to a cash register.
Man, Hinge is a monster.
The numbers coming out of Hinge are the lone bright spot on the revenue sheet. Direct revenue was up a staggering 22% to $204 million.
Incredible.
Payers were up 17%, and that explosive growth was driven heavily by their European expansion markets, which saw an 86% revenue spike.
86%. That's just wild. Hinge is the pristine growth asset within the Match Group portfolio right now.
Definitely.
It has found incredible product market fit with Gen Z by leaning into a very specific brand identity. Designed to be deleted.
Yeah, I love that slogan.
It's brilliant. It speaks directly to the exhaustion users feel toward gamified, endless swiping. Hinge positions itself as the app for people who actually want to go on a date and get off their phones.
And the feature rollout on Hinge perfectly supports that narrative too. They talked about a new feature called Friends Take, where your actual friends can leave voice or text reflections directly on your dating profile.
Think about the psychological dynamic of that feature.
Right.
A dating profile is inherently biased. I mean, everyone presents their best self. By allowing a friend to leave a voice note, you introduce authentic social proof.
It's like a reference check for dating.
Exactly.
Yeah.
It lowers the barrier to trust, which leads to higher quality interactions. And they're also building AI reinforcement learning models that actively nudge users.
What do you mean by nudge?
So, for example, if you just like a photo, the AI might prompt you to add a comment instead, because their data shows that comments lead to exponentially better conversation rates.
Oh, that's clever.
They're engineering intent.
And they have massive runway to deploy that engineering internationally.
Oh, yeah.
They just pushed into 6 new European countries and 4 in Latin America. Management reiterated on the call that they expect Hinge to reach $1 billion revenue run rate by 2027.
$1 billion.
$1 billion for the secondary app in the portfolio. And they aren't being shy about monetizing it either. They are testing a new subscription tier in Q3 aimed specifically at offering highly relevant features for women.
Hinge's growth is providing incredible cover fire for the rest of the business.
It really is.
But we need to circle back to the macro financial picture. You brought up that 14% jump in overall EBITDA at the beginning of the show, generating that massive 39% margin.
Yeah, how does that work?
Well, Hinge's growth is great, but Hinge alone isn't responsible for suddenly printing that much cash, while Tinder's revenue is slightly negative.
I am so glad you brought this up because this might be the most fascinating financial mechanic in the entire transcript. Like, how do you generate 14% more profit on shrinking revenue?
Cost discipline is part of it, sure, but there is a massive structural tailwind they're riding right now involving the app stores.
Oh, the Apple and Google fees?
We are talking about the fallout from the Epic Games versus Apple litigation and the broader regulatory pressure on app store monopolies worldwide. For years, Apple and Google operated as unavoidable toll booths. taking a standard 30% cut of every single in-app purchase, subscription, or super like sold on Match Group apps.
That is a staggering tax on a company doing over $3 billion a year in revenue, just straight off the top.
It's a massive headwind. But thanks to court rulings and new regulations, Match Group has successfully implemented alternative payment processing options in certain regions, effectively bypassing Apple and Google's billing systems entirely. The CFO, Stephen Bailey, delivered a number on this call that should make any value investor sit up in their chair.
What was the number?
They now expect a $130 million reduction in App Store fees for the full year of 2026.
$130 million in pure savings.
Yep.
That is cash that used to go directly to Tim Cook's bottom line, and it is now dropping straight through to Match Group's adjusted EBITDA.
Precisely.
That explains a huge chunk of how you expand margins to 39% without growing revenue. It's an instant profitability lever.
It is, though it comes with a slight caveat going forward.
Uh-oh, what's the catch?
They noted that Google is rolling out a new global fee structure that essentially neutralizes this benefit on the Android side of the ecosystem.
Oh, man.
Yeah, management expects their 2027 benefit from Google's alternative billing to be capped at a rather disappointing $5 million.
Ouch, $5 million is nothing compared to 130.
Right, but the existing $130 million in savings they've already locked in for this year is a permanent structural upgrade to their cash flow profile.
Well, and they are stacking those savings with deep operational cuts, too.
Mm-hmm.
They cited lower headcount-related costs and a significant drop in legal expenses as further drivers of that margin expansion. They are running a much tighter, leaner organization.
You can see it in how they were managing their smaller apps, too.
Yeah, they completely shut down an app called Archer, right?
They did. And they are doing a deep restructuring of what they call their E&E segment, Everyone Everywhere, which houses niche brands like Pairs, Azar, BLK, and Upward.
So what's the plan for those?
The strategy they outlined for that segment is called 1MG, or One Match Group. Historically, all these different apps operated in silos, building their own technology stacks.
Oh, that sounds expensive.
Very. Now, they are centralizing development. If they build a successful feature like Face Check for profile verification or the infrastructure for Tinder events, they build it once centrally.
Oh, I see. And then deploy it across all the smaller apps.
Exactly. It removes redundant engineering costs and further pads those margins.
Let's shift our focus to the future. Because as we always say on Talk Tickers, the stock market does not care about what a company did yesterday.
It only cares about tomorrow.
Right. It only cares about what they're going to do tomorrow. The guidance segment of an earnings call is where you find out how confident management really is. So what did they tell analysts to expect for the rest of the year?
For the third quarter, management is guiding for total revenue between $885 million and $895 million.
Okay.
That represents a 2% to 3% decline year over year.
Okay, stop right there. If I'm a momentum trader or a headline reading algorithm, I'm selling the stock immediately.
Oh, 100%.
They just posted a 1% decline, and now they are telling the market to expect an even steeper 2 to 3% decline next quarter. The growth story looks completely broken. So convince me why I shouldn't panic and dump the shares.
Because you have to look at why they are projecting that decline. This isn't just organic user churn. This is a deliberate financial sacrifice to fix the foundation of the house.
Deliberate how?
Management explicitly stated that the Q3 revenue guide includes a $10 million negative impact directly resulting from Tinder's user experience testing.
Wait, testing is costing them $10 million?
Yes. They are intentionally suppressing monetization features in certain test groups to see how it improves long-term retention.
Oh, wow.
On top of that, they are absorbing a $15 million hit from redesigning the Azar app after it faced a temporary removal from app stores.
So they're actively turning away dollars today to ensure the app experience is stickier tomorrow? Yeah. That is actually a sign of supreme confidence. I mean, desperate management teams strip mine their users to hit quarterly estimates and save their jobs.
Right, they juice the numbers.
But confident management teams take a hit to revenue because they know the long-term payoff is larger.
Precisely. They mentioned they originally budgeted a $60 million hit to revenue this year just to accommodate this UX testing.
Wow. $60 million.
They've actually dialed that expectation down to a $30 to $40 million impact because the Tinder rebrand was integrated smoother than expected.
Okay.
But the philosophy remains the same. Sacrifice the short term for the long term.
And the proof that the underlying business remains incredibly healthy is in the profit guidance.
Yep.
Because despite forecasting lower top-line revenue for Q3, they actually raised their full-year profitability outlook.
Which is wild.
Yeah, they now expect full-year 2026 adjusted EBITDA to come in at or above the high point of their previous guidance range, with overall margins exceeding their 37.5% target.
Less revenue, higher profits. It is the defining theme of the entire year for Match Group.
But we have to address the elephant in the room. When does the revenue actually start growing again?
That is the million-dollar question.
Like, when does the top line match the bottom line performance?
Management played a very careful game of setting realistic, highly patient expectations on this call.
How patient are we talking?
They told analysts in plain terms, do not expect Tinder's monthly active users to stop declining, and do not expect total payers to return to actual growth until the fourth quarter of 2027.
Q4 of 2027. We are analyzing a Q2 2026 transcript.
Yeah.
They are telling investors to wait a year and a half before the core metrics turn green again. In the tech sector, 18 months is an absolute eternity.
It really is.
I mean, entire technological paradigm shift in 18 months. Asking retail investors to hold a bag for that long is a massive request.
It is a massive request, but it is a starkly honest assessment of what it takes to turn around a social ecosystem of this scale.
Fair.
You cannot just flip a switch in the code and force millions of Gen Z users to suddenly change their behavior and reinstall an app they deleted 2 years ago.
Right.
The turnaround sequence has to play out organically. You rebuild the product, you rebrand the visual identity, you launch physical events to generate new cultural cachet.
Okay.
You wait for word of mouth to slowly change the brand perception, and then eventually the downloads follow. It's a slow-moving ship.
It is a heavy, slow lift. But, and this is the crucial part of the thesis for anyone considering holding the stock through this transition, Match Group is essentially paying investors to be patient.
Yes, they are.
And that brings us to the capital allocation strategy, which is, without a doubt, the most bullish element of this entire transcript.
It is the steel floor underneath the stock price. Match Group generated $527 million in free cash flow just in the first half of the year.
$500 million in 6 months.
Yeah. And management strategy for that cash is unequivocal. They are returning 100% of their free cash flow directly to shareholders.
Let's break the actual mechanics of that down, because the raw numbers are staggering for a company with roughly an $8 billion market cap.
That's massive.
In Q2 alone, they bought back 7.3 million shares of their own stock on the open market, spending $245 million to do it.
Wow.
They paid off $424 million in exchangeable notes, so debt that matured in June. And they paid $91 million out in dividends.
Right.
So by July 31st, through these aggressive buybacks, they had reduced their total diluted shares outstanding by 5% year over year.
Let's explain why that 5% reduction matters so deeply to a retail investor.
Please do.
Think of Match Group's total value like a massive pizza.
Yeah.
A year ago, that pizza was sliced into a specific number of pieces.
Okay, I'm with you.
Over the last 12 months, management has used their massive free cash flow to buy back 5% of all those slices and throw them in the trash.
So the size of the total pizza hasn't changed.
Right, but there are fewer slices.
Which means the slice I hold in my portfolio just got 5% larger without me having to invest a single extra dime.
Exactly. It artificially boosts your earnings per share because the profits are divided among fewer total shares.
That is brilliant.
It signals to the market that management believes their own stock is deeply undervalued. When a company with a massive cash cannon like Match Group is buying up their own float hand over fist, it creates a powerful defense mechanism against downward pressure on the stock.
Which perfectly brings us to the bottom line. We have dug through a mountain of data today.
A lot of data.
Yeah. $853 million in revenue, a 14% jump in EBITDA, shrinking users but higher revenue per pair, DAU trajectories, $130 million in App Store savings, and a turnaround timeline stretching to late 2027.
It's a lot to digest.
It is. We have to synthesize this for the Talk Tickers audience. We have to answer the ultimate question. Was this a strong quarter or a weak quarter? Is this stock a buy, a hold, or a sell?
It's time to weigh the evidence and render a verdict.
I'm going to take a firm stance on this one.
Let's hear it.
From the perspective of a retail investor looking for actionable intelligence, this earnings call is a cautiously bullish signal.
Cautiously bullish, okay.
I understand that top-line revenue being down 1% looks terrible on a stock screener, and I know that forecasting Q3 to shrink by another 2 to 3% is going to scare away every momentum trader on Wall Street.
Oh, they'll run for the hills.
But if you take the time to look under the hood, the underlying mechanics prove that the turnaround strategy is doing exactly what it is supposed to do.
Yeah, the data supports that.
Tinder's daily active users improving from down 4% to down 2.5% and flirting with positive territory in August is the proof of concept. They are fixing the product.
They really are.
The users who stay are highly engaged, and management is extracting maximum profit from them with incredible efficiency, driving margins to nearly 40%.
I am inclined to agree with that assessment.
Yeah.
The most actionable takeaway here is recognizing the profile of the investment. This is a classic value turnaround play. You are being asked to wait until late 2027 for the Tinder turnaround to manifest as top-line revenue growth. That requires patience.
A lot of patience.
But while you wait, you are being heavily protected by two massive forces. First, you have Hinge operating as an elite, high-margin growth engine, conquering Europe and preparing for further international expansion.
Right, Hinge is killing it.
Second, you have a management team that is aggressively cannibalizing their own share count with a $500 million free cash flow machine.
It is a highly defensive setup. It has a high floor because of the buybacks and massive upside optionality if Tinder suddenly catches fire with Gen Z again.
Exactly.
For anyone currently holding the stock and enduring the pain of the transition, it is a very solid hold. And honestly, it looks like a highly attractive entry point for value-minded buyers who want to own a cash-printing technology asset while the rest of the market is completely distracted chasing AI hardware valuations.
I think that captures the financial reality perfectly. But before we wrap up this deep dive, I want to pivot slightly and leave our listeners with the final provocative thought to mull over.
Ooh, I love a good wild card. What did you find?
Something that wasn't the focal point of the financial modeling on the call, but a data point that could fundamentally alter the long-term trajectory of the entire business.
All right, hit me.
It goes back to the physical events. Management noted on the call that their internal market research shows nearly 50% of singles aged 18 to 29 specifically want to share in-person experiences with their friends.
Wow, 50%. That is a massive behavioral shift.
It is. It completely rejects the solitary, late-night couch swiping era that defined the last decade of dating apps.
Yeah, it really does.
Match Group is reacting to this data by aggressively deploying these physical Tinder events to 75 cities this year. They're building out an entire event sourcing team internally.
That's a huge operation.
They're integrating local partnerships and venues directly into the app infrastructure.
And they also mentioned the price point for these events, right?
Yeah.
The average cost of a paid event is around $30, and they noted that 30% of the events they offer are completely free.
Right.
So it's designed to be a cheaper, much lower pressure alternative to a traditional high stakes first date.
And that raises a profound strategic question. If this aggressive real-world rollout succeeds, and an entire generation of young people adopts Tinder events as a primary mechanism to socialize locally with their friends on a Friday night, could we be watching Match Group quietly execute a massive pivot?
Like becoming an events company.
What if they are transitioning from being a purely digital matchmaking software company into a real-world social infrastructure business?
Oh man, that completely changes the paradigm.
It changes everything. If Match Group becomes the platform that orchestrates millions of physical gatherings, parties, and mixers in 75 cities every single weekend, the valuation multiples on this business have to be completely recalculated.
Yeah.
They cease to be just an app on your phone. They become the architect of real-world nightlife.
You know, we opened this deep dive talking about a nightclub that was losing its crowd and raising the cover charge for the regulars just to survive the quarter.
Yeah, we did.
But looking at this real-world event strategy, maybe the reality is that the nightclub isn't dying at all.
Right.
Maybe management just realized that Gen Z doesn't want to stand in line in the dark anymore. So they are taking the party out of the club, out into the streets, into 75 different cities, and organizing the largest decentralized real-world social mixer of the decade.
That's a fascinating way to look at it.
And if they actually pull that off, they won't just be charging a cover at the door. They will own the entire street.
It is a structural transition in every sense of the word, both financially in how they manage their margins and culturally in how they connect human beings. And that is exactly what makes diving into this quarter's transcript so vital for investors to understand.
A brilliant way to contextualize it. Thank you for joining us on this deep dive. Talk Tickers crew, we've laid out the data, the timeline, and the strategy. Keep a very close eye on those DAU metrics when the Q3 numbers drop. Watch to see how aggressively that show count keeps shrinking, and we will catch you on the next earnings breakdown.